we're trying to stay ahead in terms of innovations in the weather and derivative business. And there are many things that can be done. And what I love with that business is that it's really a sandbox. We can work with different industries. We can work with different type of needs. One day we work on temperature, then wind, then solar, then precipitation. So we can really customize the things, different granularities, etc.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here.
Welcome back to Summer Playlist 2025 on Smarter Markets. I'm Dave Greeley, Chief Economist at Abax Technologies. Our guests today are Theresa Kammel and Pierre Buisson, originator and senior structurer, Weather and Commodities at Munich Re. We'll be discussing the role of weather derivatives in managing weather-related risks as climate change and the energy transition to renewables like wind and solar are increasing the level of weather-related risks and the nature of the risks to be managed. Hello, Theresa and Pierre. Welcome to Smarter Markets.
Hi, David. Thanks so much for having us. Very excited to be here today.
Hi, Dave. Very happy to be here, and thanks a lot for the invitation.
Yeah, very happy to have you both here with us today. And I'm glad you were able to both join us because you both work closely together at Munich Re, which of course is the well-known German insurance company and the leading global reinsurer. And you work together to help clients manage their weather-related risks. And of course, with climate change, there's a lot more weather-related risks than there used to be. And I thought we could start off, Theresa, maybe you can just help us, for those who aren't familiar. What are the weather-related risks that clients come to you to help manage? And how, if at all, has the nature of those risks been changing?
Well, the weather-related risks that our clients are concerned with are the ones that you and I probably are also worried about sometimes. That can be deviations in temperature, whether it's raining or not raining when you want it, and if the wind is blowing or not blowing. So what our clients more specifically? So the range of the client base can be very broad. We have clients from the energy sector, the agricultural sector, mining, retail, construction, logistics, because in the end, everybody's impacted by weather. If we take energy, that's where both Pierre and I are serving our clients with. I think the main three perils are temperature risk, precipitation risk, and wind risk. Let's get a little bit more specific on these. When I speak of temperature risk, a typical counterparty would be like an energy utility that have client base, like individuals that heat their homes. And their biggest worry is when they sell gas or power to these clients, what happens if the winter is colder or warmer than anticipated and the amounts of power that they have pre-purchased is not matching of what the actual demand from the end client is. So the weather there creates volume risk. And similarly, the same can happen on the precip side. If you think of a big asset owner that owns a hydro dam, if there's a lot of water and snowfall in the months before, then they can generate a lot of power. On the other side, if there's a lack of precip, they struggle to generate the power that they maybe even have pre-sold in the market. And to come to the third example, on the wind side, wind can actually vary a lot year over year. And somebody who owns a wind farm has to manage these missing volumes if the wind is not blowing. So these are broadly the three buckets of like perils that our clients are concerned with and that would approach us to help them with.
And I think this is something that many people who aren't as involved as you are would find unexpected, right? I think a lot of people are accustomed to thinking of weather-related risks in terms of property damage. property damage from severe weather events like hurricanes, tornadoes, and floods. But as weather risk grows to encompass more things, as you've described, like shortfalls in wind power generation, new tools like weather derivatives are becoming much more important. And I think people need to become much more familiar with them. So, Theresa, could you help us by just kind of explaining what weather derivatives are and how you're using them to help clients insure against and manage these weather related risks?
Sure, David. That's a great question, actually. So, weather derivatives are a financial instrument that pay out based on an underlying index. So, in our case, that would be the weather peril, for example, temperatures. And so, the way our clients would use them is that they would look for such a structure that pays out whenever, for example, the winter is colder than expected, so that they get a compensation for every degree that it's colder than what the normal winter scenario would be.
Let me bring you into the conversation, Pierre, because it sounds like you started your career on the trading floor of a large utility. So you sound like you were more in the seat of one of the clients that Theresa would be talking about. But I wanted to ask you, how did that lead you to the weather derivatives market?
Many thanks, Dave. For introducing me here. And yeah, it's a bit of a journey. And indeed, it's been now a solid 15 years. I'm in the energy sector. So quite some years starting kind of counting. And actually, I didn't come directly to the energy trading floor. I actually spent the first few years as advisor for government and large corporates in energy and climate negotiation. So I really started working on supply side risk in big international meetings, also working during COP15 and COP16 with governments on energy transitions, carbon markets, all these type of elements, really mostly carbon policies and energy transition. And this is why I started seeing that market, the energy segment in general, is massively changing. There are tremendous changes. It's about new regulations. It's about new technologies. It's about really kind of market designs, etc. So we know the push in renewables, new technologies. There's battery nowadays, hydrogen being discussed, changes from fossil fuel to green technology. So really a big push there. So after a few years, I say now I really want to get a bit of put skin in the game a bit and see how it's kind of that transition is being managed directly going, let's say, under the fire of a trading floor. So that's how I moved to energy trading. It was very exciting. So to be on the trading floor when I saw those things from, let's say, a CO2 market at that time being a few euros per ton of CO2 to 50, 60, 70 euros per ton. So really kind of massive changes. And when I was working on a trading floor in a large power utility in Europe, I was always been very surprised to which extent kind of the volume weather risk was underestimated. And maybe for the audience who is slightly less familiar to mostly electricity trading, how it works is that, there's one big market being the day ahead market. So every day people start bidding for the next day. So really every day people start to already kind of engage their power plants or they buy and sell energy for the following day. And then that market is usually kind of it's a paid as cleared market. So the price on the market will be the price of the most expensive power plant starting to meet the demand. So marginal cost market as many other markets in the world. But then we are facing a huge energy transition and basically we are going progressively towards a zero marginal cost society, or at least a zero marginal cost energy system with renewables, with actually kind of demand side management, so all those things. So I was always wondering kind of, okay, that type of energy market, how will they work tomorrow or the day after tomorrow when we will be kind of fully engaged or much more engaged kind of in such a zero margin or low marginal cost energy system? And I realized that, okay, what at the end will make the price is the scarcity of the weather, or at least the weather availability. To maybe kind of take a very concrete and recent example. We all know, a few days or weeks ago, kind of in the US, there was a heat wave around Texas. Nowadays, when we are talking, kind of we are facing a heat wave in Europe and kind of there's also a heat wave in Japan. We see it's affecting demand. Energy prices are getting high on the very near term because of that kind of context. If at the same time you have, let's say, low wind speed or low solar radiation, we all know that that will have an impact because there will be high demand driven by weather and scarcity of the supply driven by weather. how this is kind of managed. And tomorrow, this should be more and more important. And this is why I thought that to some extent, kind of weather derivative is one part of the equation. It's one thing that is trying to put a price on the weather availability. And this is what actually brought me to the world of weather derivative, trying to kind of say, okay, that's where I believe that kind of we can bring financial expertise, we can bridge energy knowledge, and at the end, still helping people to deliver energy from a supply side to a demand side. That was really what motivated me.
And I'm really interested in the switch from the demand side to the supply side because it feels like it's so important. If I go back in my own career, 20 plus years, the first time I heard of weather derivatives, it was very much around heating degree days, cooling degree days, what's it going to cost, managing that risk of the price of heating and cooling. Now, as you said, with the energy transition, with much more of the grid reliant on solar, reliant on wind, reliance on hydro, there's much more trying to manage the risk on the supply side of the market. And it sounds like the weather derivatives, there's a lot more nuance, right? Like you care about how much wind blows in a certain area rather than just the temperature. Is that what you're seeing? And how has that changed the nature of the weather derivatives market?
Indeed, the weather derivative market actually started now a couple of decades ago with indeed products really focusing on temperature for the demand side. So really you think about a retail business. You're selling gas or electricity, your consumer will consume more or less energy depending on the temperature. So that's how weather derivative appear to the market. Was it too early compared to maybe kind of all the supply side risk and things? Maybe we can just discuss around that. But I find it very interesting that kind of nowadays, maybe this is when we actually really need those weather derivatives. Because as you said, there's almost much more uncertainty on the supply side than on the demand side. If you think about maybe Europe, which is kind of in terms of renewable development, maybe a bit ahead of the other regions in the globe, clearly, and you work in an energy utility, or particularly a power utility focusing on electricity, you would have much more risk on the supply side and the demand side. It's relatively easy to know, or at least it's kind of you have a lot of experts internally who can actually forecast what will be the energy demand tomorrow or next week or maybe next year, while actually telling kind of exactly how much wind you will have in 3 months, 6 months, 1 year. That's a very difficult job.
And speaking of jobs, when I introduced you, your current role is a structurer. And for people who may not be familiar, what does that mean? What exactly do you do for your clients?
We can say, and weather derivative can be exchanged and traded under very different formats, but most of the time you can resume them as financial products. So it's financial weather derivative. So a structure in the weather derivative business would be very similar to a structure around financial derivative that, as you can see, like an option trader or this type of person working on structured product. So maybe to help you a bit kind of in just understanding what really a structure is doing, I can give you a typical business day for a structure. So usually a weather structure, what we will do, kind of we arrive in the morning in the office, like a Tuesday morning, for example. First, as any kind of, I would say, energy analyst or something, we will kind of look at the market. So we're trying to log into all the market platforms that we have, following the news, looking at the prices, where are things opening or where they closed, of course, yesterday night, if there's any new things. So really to get a bit the feeling how the market is perceiving the different type of risk. Then during the day, I would say we'll split all time as a structure as kind of working on modeling the risk. So really trying to kind of put a distribution around the risk. So if we think about, let's say, a wind output, we'll try to look at kind of, is there any trend, kind of what could be a good approximation of the uncertainty around the wind output at a certain period of time, because we will actually use that for putting a price on a financial product that we will sell to a client, or a client request we have received a bit earlier, thanks to also Theresa. And the people who actually will act and work as structurers, they have actually very different backgrounds. Some will be kind of more energy analysts. We have meteorologists. We have actually very quant people, but let's say kind of it will be usually people with some kind of data skills and mathematical skills somehow to actually kind of put numbers behind kind of those phenomena. So that would be an important part of the job. There is another part, which is a bit more my role here, would be a bit trying to be an advisor for the client. So really, once we know the request of the client, we will try to enter in more detailed discussions with our counterparty and trying to understand their request. Why are they actually asking for this type of weather derivative? Because maybe we can actually bring our experience, what we are seeing on the market, also the fact that I have been on the other side of the fence in the previous life. I can maybe bring suggestions. Say, what is your risk? How is your portfolio looking at the moment? Where are you exposed? On which market are you active? Did you think about kind of trading this type of product versus this type of product and hedging it with this type of weather derivative? So there is a bit of advisory role also in the life of a structure for weather derivative, because at the end we do OTC contract with the clients. So we try to build a bit of a relationship with them to also sometimes, because we have the nose in our numbers, to suggest some small adjustment to the structure, we could make sense and make actually the hedges that they are buying from us much more efficient. So the idea really is trying to leverage the math and the numbers to best serve the client in kind of getting them somehow hedge against adverse weather conditions.
And let me come back to you, Theresa. Now, I think climate change has made all of us aware of the increase in weather-related risks, the volatility of the weather. But I think most people are unaware of the increasingly sophisticated ways they can manage that risk. Listening to Pierre, there's a lot of tools that have been brought over from the other financial markets, a lot of data that can be brought to bear. And I wanted to ask you, as you work with clients, how aware are they of the level of sophistication with which they can manage weather related risk now? And how do you help educate clients about these tools that are available to them?
Yes, David. So I think it's absolutely true that the general awareness of like weather and climate related risks has increased over the past years in the general public. If we look specifically at our client base, I think you can like divide them up into almost two camps. On the one side, we have like really sophisticated clients, and on the other side, we have very like big players, but they're not fully aware yet of what their weather risks are. But let's look first at the sophisticated clients. You can think of like big utilities or big hedge funds. They have dedicated weather teams, or at least weather traders, and with a specific mandate to always be on top of these risks, how the weather is evolving, how they might have to adjust their positions. And with those clients, they know exactly what they want. With them, it's more sort of a collaboration where we work over various months on like complex structures, as Pierre pointed out, and that's where he usually comes in. He's the go-to structure for these kind of deals. Like we work very closely on these structures to come up with a customized solution that actually like perfectly fits the client's exposure. And that's also so where weather derivatives is this great tool to be really creative, because you can structure them in very creative ways. If you look more into the second category, like the unaware but established players, there is a different game. There you have to find the right people to even start a discussion. And usually it's not done with just a single discussion or a single call, but it goes over various months because it's many stakeholders involved into these decisions. And you have to educate them and bring them all on the same page about what these risks are that they might have in their portfolio and about how they could possibly hedge them. So we try and go and understand what are these risks, what tools are available, and then try and work until we maybe come to a deal. And that often would take like a year or 2 years. It's not a very fast process. And it's certainly not a one-off conversation.
Oh, and thinking about these clients, I guess it's easy to understand now, like a large power utility that's got a lot of wind generation needing to manage that risk. When you look across your clients, what sectors do they tend to be drawn from outside of the power generation? What other types of risks are they increasingly interested in managing?
So in the energy space, I think as Pierre had already hinted at, you can broadly categorize our client base into 3 buckets. You have the utilities on the one side that have a lot of retail exposure on the demand side. Then you have the asset owners, companies that own wind farms, that own solar farms, and that have to manage the supply side. And then you have the third category, It's like investment funds and trading houses. And they might sell forward some power position in the market and then would be looking to have the corresponding weather hedge in order to support that position.
I find your question very interesting and actually trigger a thought here because you said that obviously a power utility involved in a power generation from renewable asset should be fully aware of that risk and should be active in that segment. I find it a very interesting comment. And of course, that may sound obvious to everybody listening to that podcast that, okay, that's you're aware of that risk. But actually what we are saying is though there are some players very active there and very aware of that. Some others, they thought it's part of their DNA to have to wear out that risk. It's almost like I'm building a wind farm, for example, there will be years or months with less wind, more wind, and it's the natural uncertainty of the business, and I have to deal with it. And actually, it's not true. They do not have to necessarily fully carry the burden by themselves. They can actually share it. They can find a way of actually mitigating it. But it's also the energy segments, and energy generation is also a relatively old industry, and it's known for people that there are those type of risks, and those instruments, they appeared a bit later. And I still find it very funny that when you discuss sometimes with even very large utilities, you have those who are extremely aware and some other people that say, I have to take that risk. It's in my natural obligation. I'm active in that segment, therefore I have to carry that risk. No, it's not true. You can actually hedge it as you would hedge as you are hedging yourself against commodity prices, against FX rate, against other type of risk and you're doing that every day. Why do you think it's not the case for the weather? And when you ask that questions, very often people say, I don't know. It's just that I thought it was in my mindset. So I find it very interesting because maybe some people in your audience will actually think about that right now, say, indeed, my business is weather dependent and I never thought about trying to address that risk because I just thought, okay, it's the nature of my business.
Right. It's the old thing, right? Everybody talks about the weather and no one does anything about it. Maybe to the two of you, how big are these weather related risks? If you put a dollar or euro or Swiss franc number to it, how big financially are the risks that many of your clients are facing?
So I can't give you obviously specifics on the portfolio, but to give you some feel, our trades that we would be executing can range from $1 million deal size up into 100 million and more just for a single deal, with a typical deal being around 20 million.
So those are big numbers on someone's cash flows and balance sheet. And I wanted to get back to a point you raised, Pierre, with more and more investment in renewables and putting assets in place that are going to be in place for a long period of time. How important are or could be, if people realize that they can use them, are weather derivatives to being able to de-risk these big projects and make them more bankable, make them more financeable?
It is, of course, a key challenge, and we see more and more people being worried about actually making projects bankable, or at least during operations to actually make sure that the revenues are in line with the budget that they plan. So, and also capital management is something which is a concern for more and more actors. Maybe just to actually answer that question and link it also to the previous one. In Europe, we faced over Q1 in 2025 so the first quarter of 2025, a massive wind drought. So if we look at the different countries and different markets, wind was between 20 and 30% lower than average. It had a massive impact. And I look at, for example, Germany, and Germany was a 20-ish percent below let's say, an average wind performance for the assets. And then if you take that number and you multiply with current forward prices on the market, that basically those 20% of missed opportunity in terms of production, that represents 750 million euro in terms of missed opportunity. So you're not very far from a 1 billion. And we're talking about Germany in one quarter. So indeed, we're talking at, if you just do that on all the geographies, and if you do that for the different markets, wind, solar, hydro, the temperature on the demand side of things, we're talking big numbers here. So the biggest player in the weather derivative world, we are let's say, a go-to shop, people at least going to us. But clearly, when I try to compute the total risk, I still believe we are not necessarily addressing, we are far from addressing all the risk here. We are very, very far from that. But then coming back to your questions, it's also maybe a question for, let's say, the audience here, they can think about, are there really many businesses where actually in from one quarter to another or some 1 year to another, you can easily have a volatility in revenues going from, let's say, 20, 30%? Or would you not try to do something against that? And this is what we see coming.
And maybe I can just add a very interesting example from the client side to it, where we recently spoke to a big fashion retailer that noticed like a big correlation between weather patterns and the footfall in their high street stores, and also with the timing of when they like launched the summer collection, and then it was a 2-week space of rain. So they start really to notice the financial impact and start to put numbers on it. Compared to the energy industry, they are like a bit behind, but I think the direction is there.
And I love those examples because I think one thing that people miss out on is it's not just about the dollars and cents, but once you're able to insure against these risks, you're also able to invest more. And we've talked a lot on this podcast about the need to invest in new sources of energy, cleaner energy. And if you don't have the old mindset of, well, this is our industry, we have to wear all this risk ourselves, part of wearing all that risk yourself is you'll do less of it. But if you're able to spread that risk through the market, then you'll be willing to make more of the investment that we need to see. And so I love these examples, and I'd love to get back to that, respecting the need for confidentiality. So has there been a project that you've worked on together that you would say kind of captures the opportunities and challenges for a company managing weather-related risks today?
We're trying to stay ahead in terms of innovations in the weather derivative business. And there are many things that can be done. And what I love with that business is that it's really a sandbox. We can work with different industries. We can work with different type of needs. One day we work on temperature, then wind, then solar, then precipitation. So we can really customize the things, different granularities, etc. Of course, we cannot give names of a client and things for confidentiality reason, but what I can say here is that we work with a very large power utility over the last 18 months, I would say, and they explain us at some point for their retail business on one very specific market in Europe that they had a key challenge. They had, of course, a volume risk on that retail activity because the amount of energy that they were selling is directly impacted by temperature, or perceived temperature in that case. And they really said, okay, we really need to address that risk. But at the same time, we are living in a world where we see more and more volatility on the market and geopolitical tensions. We saw that in very recently with the conflict between Iran and Israel, when actually gas prices suddenly went to the roof and things like that. So they said, we can actually we want to get a protection against weather deviations impacting our volumes, but it's very difficult for us to actually properly assess that. We want to be very dynamic, and we have a lot of flexibility to be able to really adjust basically the way we hedge ourselves against the weather versus the current dynamic, the current needs internally, the current mandate we receive from our management, the current development on the market. So really trying to be able to somehow aggregate, self-reflect about the strategy and the tactics that we want to apply, knowing that let's say the strategy is to hedge the weather, but what's the tactic to do that on a more near term? And we work with them on a relatively complex and advanced solutions to actually meet their need and also the needs on our side, because then having more and more flexibility means also for us being able to manage the capital that we deploy for the client in a very, let's say, smart way and stuff. And we work very jointly with them, going through, let's say, advanced workshop with their teams, discussing that in details, really working together on the project. It was a very positive outcome. And I think the client is still very happy with the product. We're very happy with the product. And that's actually what maybe I'm the most proud of over the last 2 years, because I agree we managed to sit with a client, say, okay, we understand your needs, and maybe we want to understand it. We want to be almost an advisor to your weather hedging business. And it's a solution which I think is pretty unique on the market. I don't want to disclose too much details here around how it works, But clearly it was, let's say, kind of fully customized to the need of that large client, rather than having, let's say, more off-the-shelf solutions, as we can see sometimes, like very basic, or the one that you described, Dave, that actually comes from, let's say, a couple of decades ago, where it was just purely temperature hedge for a season. That's the price for a missing degree. That's it. So we tried to be much more advanced, and it was a very interesting journey to go through that with the client.
A thing that's come up a few times is, I guess, who ultimately ends up wearing the risk. So the old thinking was the client just has to wear it themselves. Now they have a market where they can offload some of this risk. Pierre, you mentioned obviously Munich Re's a insurance company, so you'll have certain capital you'll put, so you'll take some of that risk that was from the client onto yourself. Theresa's mentioned hedge funds, other large investors who are getting involved in taking some of the risk in the space. At what stage are we in being able to share that risk through a larger ecosystem? Is it still, to use an American analogy, is this like early innings of the baseball game, or how developed are we? And what do we need to do to develop that ability to share risk more?
Already, as Pierre mentioned, the weather market's been around for like over 20 years now. So it's more advanced than many people would assume at first. As you said, the reinsurance companies are the big players in warehousing that risk. And I think it's also very natural for them, because companies like Munich Re, we have the capacity to take that risk onto our balance sheet, and we have the appetite, most importantly. So if you take our case, we just warehouse it all and trade a little bit, but usually we just sit on the book and wait until the winter passes, so to speak. Other players that don't have this background like Munich Re, they would just trade around their positions. So they take a very different approach. If you think ahead in terms of how to make it more tradable, this market, I think it will help if, what we see already, more and more counterparties start entering the space and bring their risk to the market. And so maybe to pick up your analogy again, we are probably in the third inning. I don't know, Pierre, what do you think?
It's exactly that. And there's a bit of the chicken and the egg here. There are many players on the market. And what we see also is that, the more people will bring risk, there is no capacity constraint, I would say, on our side to actually write more risk and warehouse more risk. We are there, and I think we have a few competitors also there, and they will be very happy to bring the risk. The more risk will come to the market, covering new geographies, covering new perils, so mixing winds, solar, temperature, and things, that actually the diversification will actually attract also, I think, a lot of players, and will even increase the capacity for the risk warehouser, if we can say that, to actually even write more risk. So I really believe that's here. The market is present. There are few players. We are, of course, one of the largest ones, and we are very happy. But there is no capacity constraint. So people should not fear going to that market, saying there won't be any liquidity. There won't be that many players, or they will say, yeah, but only that small size for the deal, because I do not have appetite for the risk is there on the market for sure.
Each of you, how do you see this market continuing to grow in the coming years? And what does it need to be able to grow and scale? As you said, right now, capacity is not an issue in terms of the risk appetite for people who will take it off of clients, yourself in particular. But if you look around, what would you say this is what we need to really let this market and this way of insuring against risk become more mainstream?
We already see the expansion on the side of the perils. When in the past it was very focused on temperature risks, now we have more and more wind and precipitations risks that clients are concerned with. And as we speak, we are proceeding on to solar risk becoming more relevant. While you might think solar risk while the sun is shining, usually all the time, just because of the sheer size of the installed capacity, everywhere we see PV panels being installed, that actually is becoming a concern. And so I think there we see a big expansion going on. But then also on the geographical aspect, currently major markets are Europe and the US, with Japan and South Korea moving more and more in the focus. We see a big momentum picking up in South America. So think of Brazil, Chile, Colombia with hydro risks and some wind risk. So I think there is plenty of room where people with weather risks can bring those to the markets. And a good indicator is always like the stage of the liberation of an energy market. Like once people actually are exposed to those risks and have to manage them, then they're concerned and will look ways to manage them and catch them. And I think we also see a rise in complexity.
Can add any other complexity. But one thing I would like to also mention here, and it's a bit of a sad comment, unfortunately, is that kind of what also we see, and coming back to some examples that we mentioned earlier in the conversation, is that when we see a relatively impactful period, like kind of some low wind condition, and we saw in Q1, then we tend to see kind of a rise in the number of demand after that. So people realize, oh, I can actually lose massive amount of money in those events. And usually that automatically translates in kind of more requests from us, and people start thinking, okay, what can I do here? We had that a few years ago in Europe. There was that drought in 2022 in most part of Europe. And after that, we saw an increase in actually the hydro power generation companies coming to us and say, oh, can I hedge myself against kind of low precipitation and drought condition? Yeah, of course you can hedge yourself, but like, so yeah, because last year was terrible. Yes, okay. So then we start seeing that type of business. So maybe that's also a bit of the sad answer, is that kind of, I mean, we need to see those things. And the more we will see those things, then it will actually it will pave the road to the future. Over the last few months, we had a few Dunkelflaute events in Germany and in Europe, so meaning kind of low power generation levels from renewables, causing very high prices. Then we see the demand for, let's say, kind of people wanting to really cover themselves against kind of low renewable conditions. So, and we see those things coming, and that actually will drive the market for the next few years. However, what we can already see in terms of trend is that increasing complexity. So people really going down to, let's say, oh, I want to look at some specific hours, or I would like to actually kind of get a dirty hedge against kind of very low or even negative power prices because it can be caused by the weather. Or I would like to combine different type of geographies, different type of peril all at once because I may be exposed, I don't know, LNG prices is driven by so liquefied natural gas by temperature difference between Asia and Europe, for example. So maybe I want to hedge myself against the temperature spread there. All these type of, let's say, more innovation is one thing that we are seeing. And the other aspect is that there is also an increasing, I would say, frequency in the trade. So people being a bit more in the trading mindset. So really kind of, okay, I want something for next month, or I want to be able to adjust my position on a rolling basis. It's a bit, let's say, different than what we have seen until a few years ago, which was people doing more their seasonal planning. Like, I want to hedge myself for the next winter for my energy sales for eating purposes. That's a bit different now. So more frequency for sure, higher complexity in the design, also because I would say, the technology behind that should be batteries, wind, solar. You have PPA mechanisms for the renewables. It's much more complex products. So people need to have more complex solutions for that. All of that is a bit, let's say, the trend that we are seeing on the market.
Well, thank you both very much. A lot of thought provoking conversation. I hope you both have some time to get away from it all this summer and enjoy a little bit of a holiday. I hope the weather cooperates with wherever you choose to go. This is our summer playlist series, and it's become a tradition of ours to ask each of our guests before they go what's on their personal beach reading list, what's interesting you outside of work this summer. So before I let you go, I wanted to ask each of you, what are you reading this summer? And maybe we can start with you, Pierre.
Some readings I started actually, I mean, it's not the same book, but last summer, so some friends recommended me Shantaram, written by Gregory David Roberts. It's the story of a guy just traveling to India and living kind of thousands life there. And it was kind of really a page turner, very easy to read on the summer holidays. And I really loved it. And I saw like kind of a few months ago that there was a sequel to that one called Mountain Shadows. So I'm pretty sure we'll put it in my luggage because, yeah, very easy. And they were just kind of, yeah, discovering new country, new culture, and a guy living thousand different experiences kind of on the other side of the globe. That sounds very interesting for me.
Sounds like a wonderful escape. How about you, Theresa?
I think I'll skip the books this summer and stick to the podcasts because I have a little one at home and barely get to grab a book. podcast these days is just really busy. So I'm looking forward to many Smarter Markets podcasts.
Thanks again to Theresa Kammel and Pierre Buisson, originator and senior structurer, weather and commodities at Munich Re. We hope you enjoyed the episode. We'll be back next week with another episode of Summer Playlist 2025. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here. Contact sales at abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.